Good morning, guys. I hope that this video finds you well. Hope everybody's having fun today. Happy Friday. I pre-recorded this video yesterday, and then after yesterday's news and setting up the M1 Finance account myself, I decided to redo it, freshen it up a little bit. If you watched yesterday's video, you know, the recession's coming. Um, at least a downturn in the market's coming. It's long overdue, and it looks like we're on the verge of it. And that being said, it's a great time to start investing. If you already have your retirement set up, it's a great time to look at it. Make sure you have things set up for your eventual retirement date, and really start maybe looking at increasing your contributions for the next couple of years. When the market goes down, stocks are on sale. Everything's at sale prices, and that's kind of the point of it all, right? Buy low, sell high. And so you want to buy it when it's cheap. And it looks like the next 3 years or so, you're going to be able to get in on the cheap. So if you're a new guy, especially if you're a young buck, man, look, if you're a young buck, you're in your 20s, early 30s, um, now's the time to do it. All right? Start putting that money in. Don't get used to living on it. You know, put that money into a retirement fund, actually into a couple retirement funds, so that, when you don't have to be that guy that's 70 years old and still, you have to drive. And look, unfortunately, the the end of the road is going to come. Um, you know, you don't want to be 65, 70 years old, have no retirement set up, and the medical examiner doesn't give you a new medical card. Because your health just isn't there, or your eyesight is going, or any number of reasons. And you're forced into retirement and eating Elpo. I don't want to see you guys there. So first up is 401ks, right? Most companies, pretty much any big carrier, big company, corporation, even a lot of the smaller ones, offer 401ks. I was extremely surprised at how many guys don't know what a 401k is, especially guys my age. Um, Everybody should know what a 401k is. So these are all going to be kind of, brief descriptions. I don't want this video to be an hour long. If anybody wants a little more in-depth uh, information on any of the topics I bring up in this video, please leave a comment below, and I will try to do maybe another video answering those questions. All right. So 401ks. The gist of it is, with a 401k, your money goes into it pre-tax. So you don't pay taxes on the money that goes into your 401k. Most companies do what's called an employer match. So if you put in 3%, they will match you 2%. And a lot of them go up to a 6-5 split. So if you put in 6%, your company will match you 5%. And how that works is, say your gross this week is $1,000. and you're doing the 6-5 split, uh, $60 of that would come right off the top and go into your retirement account, into your 401. The company would then throw another $50 into your 401. So that's $50 of free money that you're getting, right? And it's a great investment. You did nothing and almost doubled your money. There's no better investment out there than an employer match. Now, a lot of those have what's called vestment periods. By and large, most companies, it's going to be 3 years. So that money is in there every week, and your account is growing every week. But if you leave the company before you hit that 3-year mark, that money goes back to the company. And only the money that you put in there stays. So that's something that you want to keep in mind. That's where job hopping can really hurt your retirement. Um, Upsides to 401ks is that you can roll them over. So if you're with this, company A for say 3, 4, 5 years, and then you go to company B, you set up your 401k with company B, and then you roll your 401 over from company A, so you never lose that money, and you could change jobs every 4 to 5 years and still retire 30 years down the road, and never really having skipped a beat. That money, that account, essentially follows you where you go. It's your 401k. It's not the company's 401k. So that's the upside to it. Now, the downside to it is that when you retire, you will have to pay personal income tax rates on the money that you draw out of it. And so if you retire at 60 years old and you take a $60,000 a year salary from your 401k, you're going to have to pay personal income tax on that $60,000 a year. And you have to keep in mind that at that point, ideally you're going to have your house paid off, or almost paid off. So you're not really going to have a huge write-off for your mortgage interest. You're not going to have dependents living in your house, so you're not going to have those write-offs. You're not going to have, school stuff to write off. So you're going to be paying a higher tax rate just because you're not going to have the write-offs and the incentives that you do now, or that you do, well, you're in your 30s and 40s and raising your family. You're not going to have those. So and nobody knows. It's anybody's guess what the interest, what the tax rates are going to be when you retire. I mean, that's anybody's guess. Historically speaking, right now, our tax rates are pretty low. And so you're kind of rolling the dice on what the tax rate's going to be when you're 60, 65, 70 and wanting to retire, or living, in your retirement years. Uh, so that's kind of the breakdown of the 401k. The money comes out automatically. You normally will pick a percentage, so you can do like 6%, and the company that comes out of your check every week. I think you can do all the way up to like 15% into your 401k. And they have different funds, mutual fund groups that you can choose from and put your money into them. And so that's kind of the basics of a 401k. The upside is it's going to grow very fast. You can get company match at most companies. And the downside is that you're going to have to pay taxes on all of that money. And personal income, like earned income tax rates in your retirement. So you're going to pay the highest, tax bracket or the highest, type of tax on that in your retirement. All right, so next up is Roth IRAs. Essentially, a Roth IRA is the exact opposite of a 401k. Right, IRA stands for Individual Retirement Account. And how a Roth IRA works is you use already taxed money to fund it. So your paycheck goes into your bank account, you take the money from your bank account, and put that into your Roth IRA. As of 2019, you can put up to $6,000 per year into your Roth IRA. That account builds over years, just like your 401k does. And then when you retire after 59 and a half years old, you can pull that money out tax-free because you've already paid the taxes on it when you invested it. And so a lot of people use that as a hedge against higher tax rates in the future. And again, you're not going to have all of the write-offs that you do now. You're not going to have all the tax credits and all that stuff. And so you can pull that money out to live on. You can also pull that money out to pay the tax bill from your 401k. Because then when you retire, you'll just have this big lump of tax-free money sitting off to the side that you can do what you want with. And so smart money says if you are an employee, max out your 401k. Max the match is how most people put it. If your employer, maxes out at a 6-5 split, do your 6-5 split. Put 6% into there, get their free 5%, and then take another, $40 a week out of your bank account and put into your Roth IRA. That way you're investing $100 a week, and when you retire, you don't really have to worry about taxes because you have a lump of income that you're going to have to pay earned income tax on. And then you also have a lump of money that is tax-free. It's like money sitting in your savings account, and if you want to go take a cruise or take a vacation, you can pull $3,000-$4,000 out of your Roth IRA tax-free, and you can go and do that. So it's really about just minimizing your tax liability in retirement. And in the next couple segments, I'm going to get into how I invest in my Roth IRA. But that's the gist of a Roth IRA. Downside is it's going to grow a little bit slower because typically you're putting less money into it, and you're not getting any kind of an employer match into it. So it's going to grow at a slower rate. But at the end of it, when you do retire, you're not going to have to pay any taxes on that money. So it's all about being diversified and minimizing tax liabilities when you're 70 years old. So, all right, before I get into the apps I've used, the app that I just set up, and how I invest in my Roth IRAs, I want to go over kind of a brief synopsis of the market itself. Uh, the U.S. has three markets. It's the Dow Jones Industrial Average, which is large cap funds. That's going to be your big companies. It's the S&P 500, which is your mid cap companies, and the Russell 2000, which is your small cap, mom and pop companies. It's normally referred to when they talk about Main Street. Um, they're talking about the Russell 2000 stocks, those companies. And by and large, when people talk about the market, they're talking about the S&P 500. Um, know going into it that investing is a long-term game. That the more years you're in it, the more profitable you're going to be. And so, particularly, again, if you're in your 40s, it's a great time to invest, especially with the looming market downturn. You're going to be able to capitalize on that downturn and buy in while stocks are on sale, while the market's down. So, but if you're a young buck, the earlier you can start your retirement, the better you're going to be. And again, studies have been done. If you start your 401 or you start, an investment account, period, at say 20 years old, and you invest in it until you're 40, and then you don't put any more money into that account, you use your money to pay your mortgage down, pay car notes off, what have you, so that you can retire debt free. When you retire, you will have more money in your retirement account than somebody who starts investing at the age of 40 and invests all the way up to the age of 60. Because you're going to have a whole extra 20 years where, even though you didn't put any money into your account, that money was there and still growing at an average of just over 7% a year. And so the earlier you get in, the better you're going to be. Again, for the guys that are more in my age bracket, I'm 41. If you're just now starting, don't be discouraged, because we're on the verge of a downturn in the markets. So you're going to kind of be able to make up some years, especially if you're in a position where you're able to really dump some money into your retirement accounts over the course of the next 3 years. Um, you're gonna get a lot of return on that investment. All right. So that's kind of the basics of how the market works. It's a long-term game. It fluctuates. It goes up and down. If you're just starting out and you lose $50 next month, it's not the end of the world. Let history be the teacher. For since the S&P 500's inception, it has returned an average of just over 7% annually. So it might go up 20% one year, it might go down 3-4% another year, but it's going to average out. All right. Now this segment, I think I'm going to kind of combine a couple of things. And again, if you haven't already, go ahead and smash that like button. And if there's anything throughout this video that you want clarification on, or you want me to go a little something more in depth on, or you have questions on, please, by all means, go ahead, leave them down in the comment section. This is something that I actually really like. I'm actually kind of passionate about. Um, I want to see drivers succeed, both behind the wheel when they're 30 years old and in retirement when they're 70 years old. I don't want you guys out here eating Elpo, all right, hoping that Social Security is still there. I want to see you guys make it to the finish line. Um, so this is something that I actually really care about. So if you have any questions, please leave them down in the comment section. I would be happy to answer them to the best of my abilities, or at least guide you in the right direction. That said, um, the apps that I have used and the app that I just set up. I started with Ally. I forget what it was. It used to be called something else. Then Ally bought them out. They charged $5 per trade, which kind of sucked, especially when you're first starting out. That $5 is a pretty big percentage. Then I went to Robinhood. Robinhood's a good app, but Robinhood is really only for liquidity. You can't do a Roth IRA or a SEP IRA or any of that. Through Robinhood, you can only do what's called a traditional trading account, which means you have to pay your long-term capital gains tax every year on any money that you make in that account, on any profit that you make. Long-term capital gains tax is a lot lower than earned income tax, but it's still money that a tax that you have to pay annually. The only upside to a traditional trading account, and the only reason that I will keep that account going, is when I get on the doorstep of retirement, I can pull that money out to pay off any car notes, um, pay off or pay down the mortgage. I plan on having my mortgage paid for by the time I retire. I don't see the point in retiring with a mortgage note, but so that money is more liquid money. Um, you can take it out whenever you want to. If you want to pull that money out when you're 55 to again pay down those debts, um, there's no penalties or anything like that, like there is with a retirement account. Retirement account, you really can't touch the money until you're 59 and a half. If you pull it out before then, um, you have to pay penalties on that for early withdrawal. And so again, I'll keep my Robinhood account going just for that liquidity, but I'm not going to be putting a boatload of money into it. The account that I just opened last night, that I believe I talked about in yesterday's video, is M1 Finance. That's Michael, the number 1 Finance, M1 Finance. I'm not sponsored by them in any way, shape, or form. It's just an app that I use. Um, Now, with them, you can set up a SEP IRA if you're an owner operator or self employed. You can set up a Roth IRA through them, traditional trading account, all that good stuff. Uh, they don't charge anything for trade fees, so it's free to use. And the one thing that I really, really like about them that most other apps don't offer is you can do partial shares. So, like, okay, most trading apps or accounts, you have to buy a full share, meaning if you want to buy a share of Facebook, you have to pay the $917 to buy that share of Facebook. So if you only have $500 in your account, that money just sits there. It just sits on the sideline doing nothing until you get enough on the sideline to where you can buy a full share of something. I'm not a huge fan of that. With M1 Finance, you can buy partial shares. So, like, I have my account set up now. With Roth IRAs, there is a minimum initial deposit of $500. All right. So I put the 500 in there to start the account, and then I set it up. It's linked to my bank. I set it up to where every Monday, $100 will automatically get transferred into that account. And I have it set up. I picked the portfolio that I want. I picked all the funds that I want. And just like a 401k, I set the percentages on all of those. And I set it up to where it will auto invest for me. So it is truly set it and forget it. Every Monday, $100 is going to go from my bank account to my Roth IRA, and it's going to automatically get divvied out, 10% into GLD, 15% into the Spider Oil and Gas Fund, 20% into the Vanguard S&P, 20% into the Vanguard S&P, 25% into the Spider S&P, and there's another one I have in there too. And you can put as many as you want in there. You set the percentages. You can play with the percentages. And it is set it and forget it. You know? Um, I love that aspect of it. I think that these guys knocked it out of the park. Uh, the platform is extremely user-friendly compared to other platforms that I've used. It's very easy to navigate. So far, I mean, it's just first impression, but so far, I'm loving it. And going back, you can you can do partial shares. So, for example, I think I have 5 funds that I'm spreading the money over right now. Well, to buy one share of all 5 of those funds individually would be like, I think it was like $650, $700, where now, like, I could go on there and I could buy a share of Facebook, right? Facebook's trading at like $917 a share right now, today. I could go buy $100 worth of Facebook. And if Facebook goes up 3%, my $100 goes up 3%. I don't have to buy the entire. So you can be 100% invested all the time. You don't have money just sitting on the sideline doing nothing for you. I love that aspect of it. I really do. And I love how they set it up to where it is truly set it and forget it. Uh, I mean, it's basically on autopilot now. I just go in there once a month and kind of see how it's doing. And obviously, when we get into the downturn, I will take the percentages from the two S&P funds, and I will move that over to oil and gas and gold. GLD is a gold fund. And that's the next part of what I wanted to get into in this video, or in this segment, is how you invest in them. You don't have to pick winners and losers, all right? And I think that's what scares most guys, at least the guys I've talked to about it, is they think that they're going to have to be glued to Fox Business all day long. They think that they're going to have to watch Mad Money every day, and all of a sudden, like, start reading the Wall Street Journal every day, and get super into it. You really don't. They have these things that are called ETFs, exchange traded funds. They made the investing world for guys like you and me extremely easy. They're essentially mutual funds, in a sense, that trade on the stock market. And so, like, I'll take for example the S&P funds. It's a S&P index fund. Instead of having to have a share of Facebook, a share of Alphabet, which is Google, and all these different stocks, the S&P 500 index fund has all of those stocks in it. So essentially speaking, like when you buy a share of the Spider S&P index fund, you are buying 15% of a Facebook stock, 12% of a Google stock, so on and so forth. And you're buying like the entire index, the entire S&P. And the great part about that is you get instant diversification. And so if Facebook has a bad earnings report and their stock drops 5%, you might only see a 0.5% or a 1% drop. And if one of the other funds in the S&P gets a good earnings report and their stock goes up, 5%, you might break even, or if a couple of them do it, because your money is spread over the entire S&P. It's not just in Facebook. So you're not picking the winners and losers, you're picking the market as a whole. All right? And so you get instant diversification. So it takes a lot of the risk out of it, and it takes a lot of the guesswork out of it. Some very fundamental things is in a recession, in a bear market, the smart money moves to gold. That's where the hedge funds and the wealthy investors store their money. during bear markets, and so you can get, like, I have GLD, which is a gold ETF. Um, it's not just gold in and of itself. It's physical gold, gold miners, um, distributors, like all kinds of different stuff wrapped into a fund that revolves around gold. Same with my like oil and gas ETF. It's not just the barrel, the price per barrel. It's also um, refiners, distributors, shipping lines, stuff like that. So it gives you a great diversification and makes it a lot safer. And I'll be right back. But at any rate, guys, this video is getting a bit long. I knew that it would. Again, it's a subject that I really like talking about and I'm really passionate about. I don't want to see you guys, walking like the Hunchback of Notre Dame into the Petro when you're 75 years old because you didn't put away a little bit of money now and set yourself up. I want to see you guys kill it while you're out here, but I also want to see you be able to walk away when you're 60, 65 years old and be able to do what you want to do, whether that's go chill on the beach or, take 3, 4 cruises a year or travel the country visiting your kids. Um, Now is the time to do that, and especially with this bear market ahead of us. Like, that's the time to buy. Buy it when it's cheap. You know, um, it's gonna set you up for the next 20, 30, 40 years. Uh, so it's a great time to buy. If you haven't hit the like button already, please go ahead and smash that like button. If you have any questions, you know, please, please, feel free to leave them down in the comment section. This is something I'm passionate about. This is something that every driver out here should be doing. You should have an investment going. You should have a retirement fund going. Um, and between a 401k and setting up a Roth IRA with M1 Finance, it's all set it and forget it. Don't get used to living on that money, and it makes it a lot easier because you never miss that money. And it's all set it and forget it. And then when you get to 59 and a half, 60 years old, you can put 2 middle fingers up in the air and go to the beach. Anyway, again, I'm not a financial advisor. I'm not an investment advisor. Uh, I'm just another truck driver out here making my way. I've been out here 19 years, and I can't. It just baffles me the number of guys that don't even know what a 401k is, let alone a Roth IRA. That's just, you're setting yourselves up for disaster. You're setting yourselves up for being that crotchety old asshole at the truck stop, pissing and moaning that he still has to be out there when you can put away $50 a week, $100 a week now, and be able to retire. You know, even if Even if you have to semi-retire at 65 and come in and drive a truck part-time to close that gap, um, that's better than having nothing, you know. But I'm here trying to help drivers. I'm on the backside of my career. I'm just trying to help guys not make the same mistakes that I made and get set, teach them the things that I wish guys would have taught me back when I got into it. All right. Hope you guys are having a great day. Hope you're safe. Keep your shiny side up. Have a good day. Have a great weekend. See you guys on Monday.